Okay, awesome. So our panel is about compliance by design and how that relates to vaults. And I think we have a really cool variety of voices up here from different types of companies looking at compliance and vault strategies and kind of the products that those develop and the users that use them and come together. So to kick it off, why don't we do some quick introductions?
Yeah, my name is Hari. I'm one of the founders of Cantina. I used to work at the Ethereum Foundation building the Solidity programming language, and I saw firsthand how security and cybersecurity in the industry was somewhat broken, and we started a company to fix it. And these days, we work with many of our customers on all kind of security, from smart contract reviews to how do they plan their institutional strategy when it comes to like compliance and security. So that's like a new topic that we're working on, and we put this under the umbrella called Web3 SOC, which is a standard that a lot of crypto-native companies can use as they're talking with institutions and getting this large influx of capital.
Hey, my name's Ben, one of the co-founders of RockSolid. We build institutional-grade DeFi vaults, single-click, easy access to DeFi. The first vault that we launched was with the Mulackal protocol, so we're the official vault for the RETH asset. We launched 6 weeks ago, but we've been building for about 6 months. And yeah, we've been having lots of conversations with institutional capital allocators, listed companies, DATs, etc. And yeah, it's been an interesting kind of journey on meeting some of those customer needs on the institutional side. And yeah, as we'll sort of discuss on this panel, things around compliance, reporting. Yeah, it's sort of different from that degen style crypto audience, I guess, DeFi's origins. My personal crypto journey, I've sort of started playing with Ethereum in 2016. I came from a TradFi background originally, and I'm embarrassed to admit that I'd heard about Bitcoin for a long time and sort of thought, it sounds like a scam, it's money laundering, it's dark web stuff. Wasn't really interested, to my chagrin in hindsight. But Ethereum and being able to build kind of applications, and I could sort of see the writing on the wall at that time and see the kind of TradFi applications, which was the space that I was in at the time. That was kind of my pathway into crypto. And so, yeah, try to bring more of that sort of buttoned up institutional TradFi perspective to the products that we build.
My name is Juan David, so founder of Keyrock. We are a large user of DeFi technology. So we use all the protocols or the systems, and we stress test them as much as we can.
Okay, I like that. So a user and a builder. Thinking about where we've kind of evolved from, this whole Track the Vaults summit as part of DeFi Connect, and which is nestled within the Stable Summit, the Oracle Summit. I think there was a Privacy Summit, and now there's this dedicated Vault Summit that warrants enough conversations and practitioners thinking and building and productizing vaults. So looking back a few years ago, before the 4626 standard was even available, it was much more difficult and complicated to really deploy yield strategies, which was ultimately what retail within the DeFi economy was interested in, to find better yields in a more efficient way. And so I guess, Hari, if you can talk about, like, from a kind of security and technical perspective, what that innovation enabled, going from a standard token or non-standard token to this 4626 framework.
Yeah, I think from an engineering and product building point of view, I would say many years ago, people were building their own 4626 contracts. And at some point, people realized, hey, we're all building the same thing. Why don't we build a standard for the vault? Why don't we make it easily composable, so we can all use each other's vaults? So that was like a very simple innovation that people did after realizing that they were all building the same thing. Let's standardize things. Let's make it more secure when things are more standard, like things you understand the security risk much better. And I believe it was Transmissions, Joy, and a few others who built the standard. we worked with them in the early days while the standard was just an EIP, and it's great to see it's becoming like more and more common these days. But before that, everyone built their own vault, and if you had to like compose a strategy between the vaults, you have to understand how each of the vaults differed, and that's just like additional complexity, and that just added more security risk. And at the end of the day, like, why are developers spending time building their own vault when you could just like import back in the day, Solmate's 4626 vault, maybe today the Sol AD or OpenZeppelin's 4626 vault, and just make it very clear what you're doing to like your users, your integrators, and just for yourself too. Like it's much simpler. So from a security point of view, I generally think that standards make everything much more understandable. It reduces risk because now people can invest more time upfront understanding the risk, so that everyone building can now build a safer protocol.
Was the auditing time for those contracts shrunk significantly, I guess?
I would say people understand security risk of these contracts much better. There are some common issues that people look for when they audit a vault, and that by itself it's hugely helpful from a security point of view. Like for example, like a common issue is like the first depositor bug, which is when you initialize a vault, there are some nuances in who the first depositor is, and this is a common issue. Like going back to Uniswap v2, if you go to the Uniswap v2 white paper and read some of the works by Dan Robinson, they talk about this. Hey, if you're this first depositor in a pool, there are some nuances there when it comes to like pricing, and these risks also translate for 4626. But the fact that people understand them better allows everyone to build safer contracts and to have safer deployments.
One,
Actually, do you mind if I just to jump in, I just wanted to just briefly extend on that. Was I think like due to the good work that's been done at the sort of smart contract level, and that standard is now so well understood. Maybe I'll give this to you. I feel awkward. But because that standard is so well understood now, that a lot of the risk involved is actually not at the smart contract level now. It's in the strategies themselves. And not just that, the security posture and the infrastructure that goes around that, signing policies, procedures. And so, yeah, I'd love to see some auditing at that level, because people, see a lot of vault products that sort of talk a big game about what they do. Is there any way to actually verify what they do? Some of them are viewable on chain, some of them are off chain, but there's no real way to verify like what are their signing procedures, who holds the keys. Is it just some dude in a garage that is controlling your funds? So I think that's probably the next level that we need to go in the security perspective when it comes to vaults. And yeah, I hope that good work can continue on the auditing side at that next layer up.
I think that's a really good point, and that's something I want to go back to as far as like where does that responsibility reside, where we all kind of understand where a security and a smart contract auditor provides a service and what they should be doing and those deliverables. But these other areas that you just mentioned, Ben, that's not so clear. If it's the risk curator, is it the protocol? Is it the asset manager off chain? Is it all of them? So yeah, that's a good area to go back to. Juan, I wanted to ask you, with the kind of innovation in the 4626 vault and standardization, what did Keyrock look at and say, okay, now we can do more for our customers or onboard more customers because of this feature that didn't exist in a standardized way before?
Yeah, no, look, funny enough, I think that the reality of it is that I don't think users challenge the fact that smart contract works. In my view, a vault is just a smart contract. There's nothing fancy about it. The underlying risk is the only thing that matters. And unfortunately for, I would say, the use case of cross-chain vaults, I think liquidity concentrates. And the reality of it is the majority of the use cases are in ETH mainnet still, majority of vaults, majority of the liquidity is in the same space. And you get very, very little economic value from the cross-chain composability today when it comes down to customers still. maybe cross-chain composability between Ethereum and Solana already brings like a really nice factor of innovation, which helps a lot. But outside of that, for a while it looked like fragmentation was going to continue growing, but the reality of it is that it kind of like reversed its trend. I think maybe there is fatigue in the market from so many chains being launched. But I think it's more from the protocol level. So what we see is our customers are capable to deploy technology with less work in more places, which allows them to create and help communities in a much faster way. So what you start seeing is, the most simple example is you would have like Aave, and then Aave goes and deploys into like 15 chains. And ultimately, what I think that starts creating is that the app layer starts accruing more value than the infrastructure layer. And so kind of like this is the thesis that we have at the moment. The app layer accrues, I think, from 2025 to 2030, majority of the new accrue value over the underlying layer, because account abstraction and composability basically make less and less valuable the specific chain in which things run.
With kind of the increase in tokenized assets across the on-chain economy, what has been some of the conversations, Ben, Juan, I'm guessing to a lesser degree, Hari, institutions that you're talking with are kind of bringing up their concerns while at the same time interested in doing something? Like, can both of you talk a little bit about like the context of where you're having these conversations and some of the concerns that institutions have?
Maybe I can start with that one. And so I think the first part is really to understand what are institutions. So the way that we look at it is that there are financial institutions, and then there are institutional allocators, and they're not at all the same. So the fact that JP Morgan or Goldman Sachs are entering into crypto are by no means the same than a Marshall Wace allocating their capital to a vault. And there is a lot of confusion around the fact that people say, okay, institutions are starting to enter into the space, which is true, but at least to my view at the moment is financial institutions are convinced that there is money to be made from providing services to the on-chain economy, which means that we have financial institutions onboarding. But at the moment, the institutional allocation is actually really very, very little. Like, it's not happening whatsoever yet. And so I think it gets conflicted, when you see announcements of different banks coming in and tokenizing their funds or tokenizing their products. That's on the supply side. Mm-hmm. But that does not mean that the opposite's happening yet. Mm-hmm. But it's going in the right direction, I would say.
Yeah, I mean, maybe some other things I'd add to that based on the conversations that we're having. I'd agree with Juan in that it very much depends on the type of customer and the type of institution. I'd say some of the common things that we're hearing are a focus on transparency and reporting. I think that's especially accelerated in the last month or so since 10.10, and even especially so in the last 2 weeks in Stream. And it's not just kind of reporting, but it's transparency, both on-chain and off-chain. People want to see those positions verifiable on-chain, and they want to have good and clear lines of communication so they know what they're signing up for before they allocate. For a specific type of customer, which should be these, DATs and publicly listed companies, that enters into a whole new realm of requirements for that type of customer. Being a publicly listed company, how they report these DeFi positions, they have to be reflected in public financial statements somehow, which is something that DeFi has never had to deal with before. So that introduces its own new set of challenges. How do you value these positions? How do you report them as revenue? The two US accounting standards that are relevant are ASC 606, which is how they recognize revenue. They want to see DeFi yield recognized as top-line revenue because that's the first thing on their financial statements, and they need to talk to their investors about revenue. So even things like how yield is structured and packaged so that it satisfies US financial reporting standards is relevant, and that's where wrappers and tokenization can come into it. And the second US accounting standard is ASC 350, which is around fair value reporting. somewhat recently, they allowed Bitcoin and Ethereum raw assets to be carried at fair value, which is what institutions want to be able to do, market to market, and reflected at its current value. Before that, they used what was called impairment accounting, where you had to market at the lowest price that it had ever been while you held it, and you weren't allowed to mark it back up. So these assets would be horrendously undervalued on these balance sheets. But how those standards apply to wrapped assets and vault tokens is still up for debate. And some of these ETH treasury companies, for example, are taking conflicting positions on whether they're marked to market or not. So this is another area where actually vaults in particular can add value to these types of customers by wrapping these assets and revenue streams in sort of accounting favourable structures. It's almost like an abstraction layer. All these various DeFi positions can roll up into one single vault receipt token that can be structured in ways that satisfy reporting and accounting standards. That's one way to make DeFi accessible to these larger publicly listed sort of both DATs but also financial institutions that Juan was reporting to. So I think vaults are going to have an interesting role to play there as well.
Yeah, and I think the key part is also, again, transparency, because all of this metadata that can be captured through a wrapper still is being captured from an off-chain location, right? And so if that's not being reported in real time, then all that, kind of detail within the wrapper isn't really as useful, especially if it's, inaccurate. So on that topic of if there is some, let's call it misconfiguration, error, hack, where does that kind of blame, for lack of better word, fall? And Hari, where do people start calling you guys when something goes wrong?
So the if you look at walls and walls that are fully permissioned and fully permissionless, one of the trade-off is, when a permission system, there is oftentimes like an off-chain custodian of sort, or like an off-chain oracle that has to report some data on-chain. That actually minimizes certain type of risk, but also increases certain other type of risk, because at the end of the day, these are private keys, maybe a multisig or some kind of private keys that can be compromised by people. So we see that a lot of risk shift to OPSEC, and are you signing things correctly? Are you keeping your private key in a different device than what you use day to day? Are your employees not talking to North Korean hackers who are trying to offer lucrative jobs and trying to install malware on their computers? So the risk really changes. And that is the trade-off that oftentimes these systems have to decide. And if you look at some of the history of big hacks, they've always been related to private key compromises. If you look at the Ronin or even Bybit, the big hacks are almost always OPSEC related issues, and that is something that people have to do better. And what I've noticed over and over again is people only start taking these things seriously after a big incident, and then everyone's like, hey, what are we doing to prevent the same thing from happening to us? And for better or for worse, the Bybit incident has triggered a lot of people in the industry to take care of signing a lot more seriously. We are taking steps there, but it's not a done deal. And what we see in our industry is that it's very clear that the DPRK hacking group is trying to go after companies to infiltrate them, try to get jobs, try to offer jobs. The thing is that the system is much simpler to do than a smart contract hack. It's much easier to have a team of North Korean employees that are bombarding every company with the same recipe, almost like in a sales team. And it's only a matter of one person at a company that does something, and now they have access to potentially compromising access controls, and you want to like design systems in a way that a single person compromising does not lead to the entire system blowing up. But the reality is that sometimes, if a single person is compromised, that's enough for the attacker to like go from like one to the other. So it's a very nuanced topic. I don't have a direct answer on like, who to blame. But what I've learned time and time again is like a big incident really changes how the industry looks at security for that particular category. And that's been how, cybersecurity has evolved in crypto or otherwise. Why do people use like endpoint detection? It's because like, long time ago, the US government got hacked and people realized, hey, you need to secure the servers. And like, it's for better or for worse that, you need to see a big incidence for people to act.
Yeah, so it's sometimes even less about the smart contract security vulnerability, but it's the OPSEC around like, the companies and the operating best practices that they have in place. What, I guess to kind of tie up that point, like, do you think institutions, so again, looking like asset managers, tokenizing funds on chain, do you think that is one of the concerns that they have in their checklist about like coming on chain? Or do you think that they actually think things are buttoned up and it's really just about the smart contract and getting on chain and getting liquidity and finding buyers that they're more concerned of?
I mean, this is a good question, and I do agree with Juan on there are two different types of institutions, and people tend to mix them. There are sophisticated asset managers who want to allocate assets into crypto, into DeFi, into other things. When we talk to those type of asset managers, they worry about all kind of risk. In fact, we've had conversations with CFOs that came to us after reading one of our security review reports, and they came to us asking a lot of technical questions on this protocol before they were putting their own capital into the protocol. And the reason they asked the question is it's a lot of money for them. And if this money gets lost in a hack, this is potentially the end of the story for that company. It's potentially a lawsuit for him and the company because they would be liable to their shareholders. So we have seen the smaller asset managers like worrying about cybersecurity risk of the protocols they're interacting with. But when it comes to the larger, the trillion AUM type of asset managers, their compliance framework today doesn't fit with a lot of the DeFi systems at all. So there are often people inside these companies that want to do something in crypto, but they go to their compliance team and the compliance team is like, hey, we can't work with these guys because of so-and-so reasons. And a lot of times it's because these two people do not speak the same language. And they are expecting things to be done in a certain way, and sometimes it's not even possible to do that in a DeFi environment. So a lot of the work that like we all have to do in the next few months, few years would be, how do we make these two people like speak the same language, understand each other's requirements, and build products and services that suit both people's needs. So that's what I'm seeing when I talk to like people across the spectrum. There is that translation that's like breaking down today.
Maybe just one thing I'd add to that is, I agree. I think most of the risks are sort of shifting to that OPSEC layer. But one thing I'm noticing in the industry is, again, a lack of transparency about that. Like, there's very clearly this, best practice around we launch a smart contract and now we get it audited and look at the logos on our website of all the smart contract audits that we've done. But, I'm not really seeing anyone who's saying this is our OPSEC posture and this is how we have audited our OPSEC posture. This is how you know that we're doing the things that we say we're doing. There's no real transparency or accountability on that. So, one thing I'd like to see the industry move towards is some sort of framework or standardization on OPSEC and a way to kind of verify and validate that. One thing we did kind of proactively was we got an OPSEC audit. We actually went to an auditor and said, can you look at our policies and our processes and procedures and verify that A, it's best practice, which we think it is, and B, that we actually are doing what we're saying we're doing. And they were sort of kind of confused by that as well. I've never really done this before. And it's like there wasn't even really a concept or a framework of getting that done. We were trying to be proactive and kind of do better than average. But yeah, it doesn't really seem that there's sort of a framework or a sort of standardization around that. So yeah, I think that would be helpful for the industry in general to kind of move towards that as well.
Juan, any thoughts or side notes?
I might have maybe a different view on this. So why do they speak a different language? And I think the core problem is that we continue to try to use the technology to, avoid liability, which is something that basically for the rest of the world and allocators doesn't seem to make sense. So if you build software, you build a product, why would you not be liable for that product not working? It's really that simple, the question. Like, you take any type of SaaS software or banking product, if it doesn't work and they lose your money or they lose your data, they're liable, period. You can take them to court. All of a sudden now we just invented this thing where we say, oh, because we run this on a blockchain now, in my terms and conditions, you are absolutely liable for any mistake I make. That's really the reality of what it is. And so I have the same issue inside of my company. So like I want to use a DeFi protocol because I want us to be innovative and we want to test all these things. We send it to our compliance team, our legal team, and they're like, do they have terms and conditions? Send them to us. We send them the terms and conditions. Legal team goes to the terms and conditions and says, can we change the terms and conditions? We're like, well, we can try. Let us contact Morpho. So we call Morpho. It's like, guys, can we send terms and conditions? And they're like, it's difficult. I don't think we can change terms and conditions. So then legal would tell us, guys, the terms and conditions says that everything that happens in the platform is not their fault. That makes no sense. How can you agree to that? And it's like, yeah, well, millions of people are agreeing to that every day on chain. It's a difficult situation. It's not so simple. I mean, there is also a point that the legal view has on this, which is why, as a society, do we force any producer of a product? Like if you build a drone, if you sell food, you are liable for what you do. And then all of a sudden our industry insists that we are not. That's really the issue, correct? Like, why would there not be any liability? If a protocol would come out and say, hey, you're taking counterparty risk to us because if we get hacked and we lose all our money, we're bankrupt, fair enough. But if there is a hack and maybe the hack doesn't make us insolvent, we would cover the liability with our treasury like any other company in the world. I actually think a lot of people would be okay to put money if they have a lot of treasury, like anything else.
Yeah, that's a great point. And I mean, if more people kind of assign to that mindset that it's logical that as a company, you are providing certain service level agreements, and if those aren't, rendered as is and there's financial loss, there should be some type of recouping by that party that was affected. Do you think, well, it certainly will, but like, what do you think the behavior change will be if that becomes more common, right? I mean, even for yourself, like you just said, there's a lot of interesting strategies you would like to participate in, but you might be slowed down by your internal compliance, comfort level. So if that was the case across the board, what do you think the shift across DeFi would be like?
I mean, the thing is that like it's more like for companies and users that don't have the level of sophistication, this is a big issue. So in our case, okay, so these companies don't want to take liability. So what does that mean for us? Oh, we actually have to have an in-house cybersecurity team of 5 people so that every time that there is a new protocol, a new startup that has built something cool, we can be agile and say, okay, let's have a look at this. Our trading team wants to use this thing. Cyber guys, please have a look, review it. Legal team review the contract. Legal team says the terms and conditions are shit. We know it, fair enough. And then can we use the contract? And then the cyber team would come and say, okay, the contract actually looks good. It's been audited. And we also run some stress tests, and I think we could do it. Then after he passes that, then he goes to a risk appetite model, which is no matter what you do, you need to first understand how much risk you want to take. And so then companies that are sophisticated will build a risk appetite, categorize something into a bucket, and then according to that, allocate. But that's also the case in anything, correct? Like we will have a risk appetite to Binance as well. We would never put all of our capital in Binance either. In this, we would never put all of our capital in Aave, even though it would be highly rated. We'll never put all of our capital in Morpho. And so for us, it's okay because we know how to run a risk appetite model. We have a cyber team. We can do all this crap, yeah? But an institutional allocator just looks at this, and the first thing that they see is, why the fuck are these guys not taking liability? This makes no sense. And then we get stuck there. So of course, like the whole thing, if it would change, it would be very healthy. If Aave would come and say, hey, if there is any failure of any of our vaults, we will pay. That's simple. It's presumed that it will be the case, and that's the thing. The majority of people in our industry presume that if a protocol has a big treasury, they will be responsible. But they also may not be responsible. And we have seen situations where a lot of protocols have actually been very responsible. And so I think founders intuitively know that this is the case, that if they fuck up, it makes sense that they should use any last resort to compensate. But they're not legally accepting that liability beforehand.
Ben, through your service of providing a white labeling vault infrastructure, how do you think about liability in these things?
Yeah, I agree with Juan, actually, agreeing with everything you said. I think the challenge is there's few companies that are large enough. Their treasuries are a fraction of the TVL that they secure. A lot of these protocols have hundreds of millions, billions of dollars of TVL. How big does your treasury have to be to make that up, assuming, you lose a big portion of that? But I agree. I think companies should be more responsible with that. Unfortunately, you talk to a lawyer, and if you're depositing into something, your lawyer will say those T's and C's look shit. And if you're deploying a vault, your lawyer will say, put in all the T's and C's so we're not liable for anything. So, unfortunately, kind of lawyers get in the way from both sides. But yeah, I think ultimately it comes down to transparency. I think people should be able to understand the risks that they are taking, assess them themselves, and opt into it. I think that's what kind of smaller and newer protocols can do in the absence of having a large treasury to kind of backstop. And just not trying to obfuscate things. We saw with Stream blowing up 2 weeks ago, part of the problem was no one knew what they were signing up for. There was one line on their website that says we do delta neutral strategies and a combination of A, B, C, D, and that wasn't actually what they were doing, and the majority of it was off-chain, and there was, you should have been able to verify, hey, we can't see this on-chain, so there was due diligence to do, but the risks certainly weren't transparent. So I think transparency is the immediate thing that everyone can do, and I think we've seen a lot of protocols and a lot of vaults immediately rush to that in the aftermath of Stream. So we're heading in the right direction. It's tough. These are not easy decisions.
I want to add something here where, part of the reason why nobody wants to take liability is because there's no mechanism to do that. I was very happy to see, at least on the Aave's new announcement, that they're offering up to $1 million in liability. I don't know what mechanism they are using to do that, but I want to see more insurance players that are willing to underwrite some of this risk. And ultimately, this is a math calculation. What is the probability of you losing money? What is the premium going to be? How do you minimize the risk? And in a cybersecurity context, the risk always goes down. You can always price in the risk of a hack, but one thing that people don't talk about enough is what's the probability of a hack getting recovered? And this is something that we as an industry need to figure out, where these hackers, they are human beings, and oftentimes in jurisdictions that they can be taken to custody and be recovered. And the higher that number is going to be, the more you can minimize the risk, which means that a lot of the insurance products make sense. And maybe if Aave wants to offer this, they can partner with some large insurance broker who would price the risk and decrease the yield appropriately. So that's what I want to see the industry going. And I completely agree. If something like Aave with some insurance backstop, that's now a very hot product, for consumers.
Totally. Yeah. And with that, I think, what the teams, particularly all of your teams in their current form, it sounds like there's opportunity to hire more security or legal practitioners or, insurance vendors to scale, the demand and just kind of the ability to safely service these types of products. So with that, we have 1 minute. Thank you to the guests. This was a great conversation. I believe it's the last of the day. And this has been fantastic. Thank you, Emily, too, for emceeing.
Thank you. Do we have any questions from the audience?
Sorry.
Yeah, I'd like to bring up stream finance because it had such a big impact the past 2 weeks. And you mentioned that it wasn't very clear on their website. I agree on the UI, the user-facing UI, those risks are invisible. But then again, we had a lot of professional risk curators who did engage with it. If you go into the documentation, one of the first things you read is a function that the owner can call to withdraw all the funds from the contract. So it's actually not non-custodial. And what do you think could be like a solution to avoid these type of situations for end users? Because now they don't only have to think about the, let's say, the product to interact with, like Morpho, for example, but they also need to do a selection of the curators, because it turns out not everyone has been taking that job so seriously.
I'll give a 10-second answer to that. I'm curious to hear your guys' perspectives as well. But I mean, most of these curated models have trust assumptions baked into them. The curator controls the funds through some sort of mechanism, and ultimately you are trusting them. That's a function of the model. So I think the curator's reputation matters. Their transparency and their reporting matters, and doing technical due diligence matters as well. But I don't think you can get away from the trust assumptions baked into the curator model unless it is a purely trustless architecture. So
Maybe my view on this is, on-chain technology should be permissionless. So I do believe entirely in the model of Morpho. But the fact that it's permissionless doesn't mean that the user layer should deal with that complexity. And so we have gone from, let's say, money markets that are dominated by Aave to now, something that is permissionless. And then I think what you see is that now there's a lot of products going back to aggregate and diversify risk. And so the very simple way to look at it is in traditional finance, if you look at a credit fund, no one would take a credit fund that is only rated by one counterparty. It would also be crazy, correct? So it's the same. So you would ideally, and we're actually working on this at Keyrock, put together some sort of fund-of-fund type model where you would have diversified allocation to different type of non-correlated credit. And actually, that should be the healthy way in which the end user takes exposure to it. You cannot guarantee that all the curators are going to do the job well. There are going to be companies that are doing their job badly. The reality of it is that it's the beginning of curation. So a lot of these companies, their incentives are actually not aligned. But the V2 model of Morpho is going to be a lot more dynamic, and it's going to actually be able to show how these curators operate differently. As well, for example, in the V2 vaults, curators are going to have the capacity to manage their own liquidations if they want to. So only very sophisticated curators that can not only select a couple of assets and publish a vault, but they can also take on liquidity in moments of panic, will be able to do that. So then as an allocator, you rather put your money in a curator that can not only select assets, but actually also liquidate them in an efficient way, which would mean that the liquidator has to be more diligent because now has a skin in the game compared to now that they don't really. So they could just take stream finance. Well, if Keyrock puts a token in a vault, and then we say, okay, we're going to commit to also be the liquidator of this, then we better be sure what we put in there, because in case it defaults, we're going to be holding the bag. And that should actually protect you a lot more if you would know that the curator is also the forced liquidator of the asset.
Maybe to add, I think in the traditional finance world, there is this role of the S&Ps and the Moody's that tend to rate products, and this is sometimes a requirement to get certain type of capital. I think we will likely see some things in that direction. The other thing that is also pretty important is, which touched on the legal liability. There's almost zero liability or recourse for many of the people doing things on chain today, and I'm hoping that would also change. A lot of this, people, especially in crypto, tend to talk a lot about how the U.S. financial system is broken, but there are some things that you can learn from that, especially when it comes to like recourse. Like if you do something that's like straight up fraud, you will go to jail. You will be able to like get customers' money back in some way, shape, or form, and that doesn't exist today because a lot of the entities are some random Cayman entity or like some random offshore entity. So I'm hoping to see like more changes in all fronts, from one like sophisticated risk assessment, people like telling like, hey, these are the risks, to like better legal protection for users. I mean, I'm hoping that it's a U.S. company with some liability versus some random Cayman Island entity that you don't know who your counterparty is.
It was mentioned earlier how ideally we could have ratings for like vaults in addition to like smart contracts risks, like having them audited. But it's actually like very different skill set to be able to audit like a financial strategy versus like a technical product. I'm curious what you guys think is kind of like the current best in class way that risk strategies can be evaluated, and what would you guys like to see in the future? Like what would a dream scenario be for being able to evaluate the risks of these vaults?
I can answer that. Unfortunately, the answer is actually quite long, so I'm not going to be able to give you the real answer. But if you look at how these risk models are built, they are kind of like built out of first principles. So you first start assigning kind of like ratings to all of the underlying piece of the technology and the underlying piece of the assets. The problem is that a lot of these things are kind of like nested. You could look at it. So you would say, you have this asset. What is the risk of that asset? Well, the asset has some liquid stake asset underneath, or has another asset underneath. And where is that asset living? Okay, maybe it's living in Arbitrum, is it living in mainnet, is it living in? And so and is it interacting how many protocols? Oh, actually, they are using Pendle, they're using Aave, they're using Morpho. But if you're actually smart about risk stacking is a concept, you can actually build pretty dynamic models that assign ratings to all of the different components, the chain, the protocol, the nested of the asset, and the time. And so what you would assume is that it's kind of like the Lindy concept. The longer the time one of the components has survived without failing, the more time contributes towards its subcomponent of risk. And so you kind of like end up with something where you have everything in modules, and then you can say, okay, what is the risk of this thing? And you with that risk stacking, you this plus this plus this plus this plus, and then boom, you get a score. And so that's what an actual proper creator should do.
Maybe I can take the last question. So you guys talked about insurance and liabilities. How do you feel that in this space, everyone is always fighting for liquidity and for yield? And the fact that if you start factoring insurance, it will take you 50, 100, 200 BPs. And basically, retail will not take it because of that. At least, we have seen that.
I have a pretty good answer for this one, if you let me. I fundamentally have thought that the key to actually be able to build insurance on chain is to do underwriting of risk with very risky assets that are decorrelated. So if you think about why is that risk is so expensive, is because you need to get paid a yield that is meaningful on your capital to be able to justify the risk that you're taking. So let's say the risk of a smart contract failing, how do you quantify that? But if you're allowed to get extra yield from underwriting the risk with something that is inherently very risky, the appetite and the willingness to pay would go lower. So I'll give you a stupid example. Let's say you want to underwrite the fact that Morpho could fail. So like Morpho smart contract insurance. But you allow the person that are underwriting that to do it with JLP tokens from Solana, which is a decorrelated risk. It's in a different chain, it's a different strategy. And so you can continue still to compound and get the yield out of your JLP, and then maybe you only require a few points more of added yield. So it's kind of like a win-win situation where the risk underwriter gets kind of like a restaked of a highly risk asset. And the only risk is really if both items would fail in tandem. So basically, can Morpho and Jupiter be hacked in parallel? Well, the probability is low, correct? So you would need to start understanding all of the factors that correlate them, and hopefully be able to abstract that to build insurances that are basically allowing to compound risk on risk to reduce the cost.
Is there a company that does that?
What?
Is there a company that does that?
Not yet, but
Not
I
yet.
give the idea to a couple of people. Every time I get ideas, I give them to people, but like I don't know if they want to build them or not. Unfortunately for me, I got already my own company.
Maybe to add into that, I think we need to start thinking about sort of risk-less DeFi yields to TradFi yield rather than other DeFi yield, because the DeFi only capital and TVL is pretty small when you compare to like how much money is out there in the market. I don't think we're ready for, let's say, $1 trillion in assets on chain. And like if we are talking about numbers of that scale, then insurance make a lot of sense, and the yield may not look as attractive as like DeFi yield, but it's still going to be higher than what you get from your bank or maybe like a high yield savings account. So I think the comparison with the insured yield should be to TradFi, and you can build much better simple products than the traditional products, and those numbers can look much bigger than some of the DeFi native markets today.
All right. I guess this is it for today. Thank you so much. And thank you for staying till the end. Thank you.